Welcome to another episode of the Global Investors Podcast. I'm your host, Charles Crillo. Today we have Ashley Garner. He brings over 30 years of multifamily experience, concentrating on reliable workforce housing throughout the Carolinas. With 3 decades of experience, he has operated hundreds of units across multiple markets, shaping his firm, ABG & Associates, underwriting and long-term investor model. So Ashley, thank you so much for being on the show today.
Hey, Charles, thanks for having me. I'm excited to be here. Appreciate it.
We were just chatting earlier. You got some snow in the Carolinas, so that's exciting. But before we jump into what you're doing now, can you tell us a little bit about yourself, both personally and professionally, prior to getting involved in real estate investing?
Yeah, I'd be happy to. So prior to real estate investing, I was in grade school. I mean, really. So literally I grew up kind of in a mom and pop version of what I do now. When I was in, back then we called it junior high, but in the mid 1980s, my dad started buying old houses near the campus of a major university, and we would internally subdivide them, renovate them, and make them into multiple apartment units in these big old houses. And then we would rent them out to college students. And so I grew up with the hammer and the shovel and doing all that stuff. And then as I grew up, I guess I went into the operations and the management and the acquisitions and legal and things like that. So, and then when I became of adult age, I don't know if I grew up or not, but I came of adult age and started buying things on my own account. I started probably the way a lot of people start, with single families, duplexes, triplexes. And then I realized that, hey, this thing really works. It's an amazing, the potential to achieve that financial freedom goal is actually real. But I realized that, I like to say I was going to be mathematically eliminated from achieving my goal if I didn't somehow pick up the pace. And so I started buying more unit count, like a 10 unit, then 32, then 35. And then the most recent one we bought was 196 units. And that was just less than a year ago that we bought that. So that's kind of what brings us brings the last 40 years up to today. And our intent is to keep buying properties at 200 unit size or larger until we get at least to 1,000 units, and then we'll reevaluate.
So when you were starting out with your family, and that's similar because my dad was a real estate investor and he self-managed everything, and he bought like maybe his first sixplex a few months after I was born. So it was like elementary school. It was a whole different education for me of learning, and it was D-class properties, apartments. So it was even very tough, much tougher than college kids. But tell us about how that, like some of the things that you picked up there, maybe some lifelong lessons that you've kind of brought through to what you're doing now. And I imagine when you're talking to other investors that you're helping getting started, or when you're talking to any passive investors that you kind of take into your business today.
Yeah, sure. Well, so the business is basically the same, whether it's a single family rental or it's a 200 unit complex, or, class D versus class A. The spreadsheet the math is the same. The basics of the game are the same. But for me, in order to scale, like I said, when I meant mathematically eliminated, I meant that, if you're making $250 a unit cash flow each month and you have 10 units, well, that's good. And that helps you pay bills, but that doesn't get you multi-generational wealth. It doesn't get you to quit your day job. And so you have to do enough of it that you can achieve those things. So you have to scale. And in order to scale, I had to learn to put the hammer down. I had to learn to delegate management and all of these types of things. So in order to scale, I had to build a team instead of just doing it all by myself. That's probably the biggest change. And then, of course, we can talk about the financing and the raising of the capital. Those are 2 different things also as you scale up. But the main part of it is really I had to learn to let go and build a team and trust them to do their job.
Yeah, it's an important thing. I remember the first time I hired a third-party property manager, and it was something my dad never did. And So when I did that, and it was, yeah, I mean, it's, you just have to be comfortable with it. It's a weird thing, you know what I mean? But you now can focus on making more money and finding more deals, you know what I mean? And it's a little different thing, but it's nice to have a little bit of not being on call like 24/7 as a property manager. So
yeah, I went through a phase where I actually, as a part of ABG and Associates, I had ABG management. And so we managed all of our units. And at that time, it was pushing 300 or more units we were managing, and which, is big to some and small to others. But to me at the time, it was big. And so I had an employee, I had the software, I had the whole thing. And what I realized was that it was costing me the same roughly 10%, whether I had that company myself or whether I outsourced it. And you have to value your own time. So my time is worth money. And even though I don't write myself necessarily a paycheck, I was spending a lot of time on that. Plus there was a lot of stress involved for me. If the toilet leaked or if the sewer line backed up, I somehow was still involved on a Saturday night, even though I had an employee, or if the employee called in sick, blah, blah, blah. And so I realized for me that I could outsource it to a third party, cost me roughly the same money, but my existence was much less stressful because of it.
Yeah, that's one thing that I see. I always kind of think twice to myself when I have people on the show, and some people are, they have large portfolios in one specific area. And I get that, the vertical integration. I understand that. But it is such a tight margin business. You know what I mean? And you're consistently looking for new people, because if you are, you're just consistently looking for new handymen, new people to deal with. These aren't really highly paid people. So they're maybe not the most responsive and reliable in many cases. So it's just a very difficult business to run. I was like, if you're going to do any part of it, if you're going to pick out where you want to actually do some vertical integration, I would say it's I would buy an HVAC company and plumbing, mechanical company, and, or I think, or do something with construction, become a contractor, whatever it might be. But with the HVAC, the amount of you have techs come out, they're well-paid people, and it is very expensive per hour to do that. And that's something where you're now I can it's not 10%, it's 30% that I can shave off. You know what I mean? 10%, it's not worth, property management is a thankless job. No one ever calls you and thanks you for it. And, I don't know. It's a difficult business.
Yeah, that's very right. You only get the phone call when there's a problem. You're right.
Right. Yeah.
Yeah. Good point.
But so with what you're doing today, and can you tell us a little bit kind of so going into what you're doing now? So you've got into larger properties. I know you started maybe 10, 12 years back. You started with a 10 unit property, and you've moved that now into doing almost 200 unit deals. So can you kind of break down your firm's current investment strategy and philosophy of what you guys are doing?
Yeah. So really our focus area is the state of North Carolina. Doesn't mean we wouldn't go out of it, but North Carolina checks all the boxes that we need as an investor, that we need it to check. And there's more than enough opportunities so that we kind of stay focused right there. So that's one thing. And like I said earlier, ideally 200 units or larger size wise. And then from then, we're probably in the midst of evolution on our criteria a little bit. So the 196 unit property that we just bought, it's more like C-class workforce housing in a smaller market. And while the returns are very, very, very good, and it's strong operationally, we realized that it was not quite as easy to raise capital for, and it was not quite as easy to finance. There were less options for those things. And so we're evolving in our profile of our investor to a more family office, high net worth investor, a little more savvy. We find that those investors really value a little bit larger market and a little bit newer asset class. So we're kind of shifting our goals up a little bit, if you will, to bigger markets and maybe class B+ to A assets.
Is that what you're finding when you were financing? Tell us a little bit about kinds of the challenges that you had from financing deals previously into what you're doing. Because I imagine with those smaller deals, you maybe were doing seller financing or banks or credit unions locally. How has that kind of evolved into what you're doing? Are you getting agency debt, or are you still using local banks and lenders?
Yeah. So, like the 10 unit place, the 32 unit place were all kind of local banks. And those, I still have those, both of those loans. Well, the 10 unit I've refinanced 3 or 4 times. It's been a wonderful story. And the other one, the 32 unit, I still have the original loan. It's like 3.25% and it's a fixed interest. Now, the downside is it's full recourse, but then the 35 unit we assumed a Fannie Mae small balance loan. It was already in place and we assumed it. And then the larger property, we ended up taking it to a HUD 223F loan, which we're actually getting ready to close that refi in about a month. But what we found on that one was a real lesson for us. So we started out pursuing Fannie, then Freddie, and we could have gotten the debt. Well, actually, Fannie wouldn't even do it because the market was too small and they didn't like the market. Freddie would do it, but they would only do it at like 60% loan to value. So you're buying a $22 million property. You know, the difference between an extra 20% of capital you've got to raise is a huge number. And it just made everything harder. You know, you had to raise more money. You couldn't borrow as much. The terms weren't quite as good. So everything is just a little bit tougher. It doesn't mean we couldn't do it. It just was harder. So that's one of the reasons that we're looking at different, slightly tweaks in our criteria, because we just have, there's so many more, packages available, if you will.
Mm-hmm. When you're taking over that deal, you assumed one, right? And, an agency debt deal, what issues have you found with working with agencies? Because I've had them before, and it's definitely a much more involved process than getting a bank loan, right? The banks really don't bother you if you're writing your check. You know what I mean? It's the agency lenders are much more involved with your deal. How have you found that?
Oh yeah, so yeah, the reporting requirements, the resume requirements, the requirements that they put on your property managers, the reserves that they require you to have, everything is stepped up a notch. And really this HUD loan, excuse me, we're getting ready to close that after it's been a good solid 10 months of the application process is 10 months long, 10 months, which just blows your mind. I mean, it's going to be amazing because it's a 35-year loan with a 35-year fixed interest rate, 35-year amortization. So it's an unbelievable product when you get it, but you definitely go through the ringer to get it.
I didn't know it was 10 months. I've spoken to people before and they said it was 6. Can you talk about a couple of I know there's a couple caveats with it. The famous ones being that you can't do quarterly distributions. I believe it's twice annual distributions you can do to your investors. What other things are there that might be different from other lending type programs?
Well, I know one thing was the amount of reserves that they require us to have in place. So repairs prior to closing, there are lots of things that they want. They want everything right, and then they'll close. And then, it's a 35-year loan. So they're going to have a lien on this property for, 3.5 decades. And then that all of the roofs will need to be replaced by then. All of the HVACs will need to be replaced by then. So they say, all right, well, you're going to have a really big stack of cash in the bank with us on reserve so that we're sure that you're going to be able to keep this asset in the condition that we want it. And so I personally like that because now it's all it's like a forced savings account. It requires much less self-discipline when you know it's there. And so I think it gives comfort to our investors as well. So I don't consider it a bad thing. It's just some people don't like to be told what to do. And if you're going to do a HUD loan, then they're going to tell you, yeah, we'll do it, but this is what you have to do to get it. And so we're okay with that.
Interesting. Very interesting, type of program. One of the things I guess with agency, when everybody ever says agency, they always make a note of their recourse or non-recourse. And I understand banks are recourse lenders. They can go after your personal assets, but it's also one of the things too. I mean, the agency lenders have their own kind of like blacklist too that they put people on. I mean, it's there. You're, and then like there's carve outs in there too. I mean, there's a lot of stuff. It's not just like you sign it and if something happens, you're done. Like there's a lot of recourse. I don't think that's spoken about too much. And people just like broadly say, oh, your personal assets aren't like liable. But I mean, you're going to have a very negative situation if you don't pay a bank loan as you would an agency loan, I feel. You know what I mean? And you probably won't be doing any more, too many of those anyway, or any more agency loans in the future.
Yeah, you're right. From what I've heard, and I hope I never find out, but from what I heard, if you get on the wrong side of the agencies, then yeah, it's pretty much game over as far as using them for financing. Yeah, you're right. Theoretically, you'd at least still have your own personal house to live in. They can't come and take it. But doing business with them in the future would probably not be an option. So there definitely are penalties if you don't perform.
Yeah. It was one of the things that we had with a property we sold a few years ago that was Fannie Mae. And we sold it. Everything was fine. And it was going through COVID. We sold it during COVID. And we said we were going to do X amount of units. And it was maybe like X minus maybe like 10 units that we didn't renovate. And after we sold it, everybody got paid off for it. And still issues with Fannie and stuff like that. And, use them since, but it's something that it's like, it's just like, man, like everything is you gave them a business plan and you're like, well, how do you renovate units during COVID? Do you know what I mean? Kind of a thing like that. And all these different things. And it doesn't really matter. You have to, whatever you tell them or whatever's happening, you have to do it all the way to the end to have completely no issues. And it was like, everybody made money on the deal and they're going to, they're putting their money back out on the street and we had to pay prepayment penalty because interest rates went down and all this stuff like this. But yeah, it's, there's a lot more than just non-recourse and recourse is what I'm trying to, I guess, talk to people about. But going back to what you've got going on with, tell us about like what you've got going on with sourcing deals. Cause you larger deals now, I imagine you're going through brokers. With your smaller deals, were you sourcing those direct to owners? How are you doing that?
Yeah. So I have done it kind of all the ways. I've done it, the 10-unit place I bought off of the MLS. It was listed by a residential broker who really didn't know anything about multifamily or what they were doing. So I've done that. The 32-unit place I bought it direct to seller as a result of a paper like snail mail mailing campaign that I did. He got the letter. He called me up. We did we did the courting dance for 3 or 4 months and sure enough was able to buy it. And then the others have been through like large commercial multifamily brokers. So I've done it kind of all different ways. It's all about relationships though. I will say that every one of those situations were because I created a relationship somehow, some way with a human being. It wasn't just, find something on the computer or drop out of the sky. There was a relationship behind it.
Do you have money sitting in the stock market and you're worried about it? Or worse, you have money sitting at the bank, not keeping up with inflation? My name is Charles Carrillo, founder and managing partner of Harborside Partners. And since 2006, I've been investing my money and my family's money into income-producing properties. These are real assets, real properties with real addresses that produce real cash flow. At Harborside Partners, we provide passive investors who love real estate with a turnkey investing solution. If you want to put your money to work in real estate but can't find deals, don't have the time to get funding, and the last thing that productive people want to do is manage real estate. We find the deals, we fund the deals, and we manage the tenants, the termites, and the properties. Partner with us at investwithharborside.com. That's investwithharborside.com. Go to investwithharborside.com. If you love real estate, you like the idea of passive income, and believe that income-producing properties will appreciate over time, go to investwithharborside.com. That's investwithharborside.com.
Yeah. Yeah. When you're doing that direct to mail, you're starting that relationship with them. And I mean, you're probably not buying that property anytime soon. You just want to know in the next year, 2 years, whenever they're selling it, many years down the road, that they're going to call you first. You know what I mean? And that's kind of how that whole thing works. And some people are ready to sell sooner than later. So it's, it's like you said.
Yeah, those things are a timing. Those types of things are definitely a timing issue. And you have to be consistent, with your periodic contact, because if I send you one letter ever in your life, and the one day you get it, you're not ready for it, well, it's kind of a waste of money. But if I send you one every 3 to 6 months for the next 3 or 4 years, then maybe there's a chance I hit you at the right time.
Yeah. Yeah, it's interesting. Everybody has different life events that happen, and stuff changes. You know what I mean? So for the good and bad in people's lives, and you might be there to take that asset off their hands when they're ready to dispose of it. What would you say would be some of the things about being focused on one state, one market? I mean, how does this ever work with, what are the advantages that you have found with that? And would you ever think about expanding your target market? You mentioned it in the intro a little bit, but I mean, what would you found of those advantages of just focusing on one place pretty narrowly?
The advantage of the focus is that we really have that market niche specific knowledge, and we have the team. Like, if it's anywhere in the state of North Carolina, we're plug and play, like, boom, make it happen. Like, the attorneys are there, the contractors are there, the property manager's there. I just insert the property into the system. So that's definitely an advantage. Plus all those relationships that we talked about that are very strong and kind of cover most of the geographic area. That's a definite benefit than if we were just saying, we're going to focus on everything south of the Mason-Dixon line and east of the Mississippi. It's just for us, it's just too big of a market. Now we would certainly consider, we're looking at the Greenville, Spartanburg, South Carolina area, maybe, certain parts of Georgia on I-85, that kind of stuff. But still, that's pretty close to where we are still. And we would consider that. But frankly, it would have to be a pretty good deal, because there's enough good opportunities right here in North Carolina that we really, until we run out of those, I don't see any reason to chase something somewhere else.
Yeah. And how you explain that too is, I mean, as I'm a passive investor as well, not just an active multifamily investor, if I'm speaking to someone and just kind of how you explained it, where you're plugging in a new property. So everything's all set. There's not going to be a change of management. There's not going to be an issue with finding contractors or anything else that comes up. I mean, you're pretty much I'm kind of just riding on your coattails on that, seventh property or whatever it is in that market that you're putting me into. And it's, we're not reinventing the wheel. And I think that's a very strong place to be in when you're speaking to passive investors versus someone that's like, oh, we have one asset here. We have 3 assets here. We don't have anybody on the ground here. We don't really, you know what I mean? It's not as vetted as well. And when I've passively invested in deals where there's where they have a pretty strong portfolio on the ground nearby the asset, whatever that might be, 15, 30 minutes, whatever. That's when it's worked out the best, I found.
Yeah. Yeah. I certainly would agree. I think that definitely makes us attractive to people who live outside of the area, because now they know they can come in and benefit from the work we've done to build that system. And I was just talking actually with yesterday with someone a general partner, somebody who does what we do on a much larger scale, and they are based in the Midwest. And so the conversation was basically about co-GPing on deals in North Carolina. And that's really what we bring to the table. I mean, we're way smaller than they are, much less infrastructure, but we have the local knowledge, we have the relationships, and and that's something that they can benefit from us, and we can benefit from their scale. So yeah, it's a pretty big deal.
Yeah, I think being really focused on one market allows you to know those rents inside and out. You know exactly what the real rents are. You're not searching for comparables all the time. You know cost of utilities is per unit. I mean, insurance. It just makes everything work a lot easier when you're into one local area. I have found over the years of buying real estate. As you mentioned before, when you're buying real estate, initially, and you're saying, well, it's really hard for that generational wealth at $250 a unit that you're making. Many people are doing something else on the side. And I know for you were a real estate broker. Can you tell us a little bit about, other than upfront money while you're building out your real estate portfolio, but how did being a real estate broker assist you with becoming a successful real estate investor?
Well, one specific example is that 10 unit place that I bought off of the MLS. I would have never seen that, or I would have seen it too late if I wasn't kind of behind the scenes in the real estate on the brokerage side of the business. So that was a direct benefit for sure. And I'd say the other is that I have had, 20 years of developing a database, of creating a trustworthy reputation. So now a lot of those people that I have put in my database, if you will, over the last 20 years, those have become investors in the multifamily business. And maybe I met them by my team selling them a house, 15 years ago. So that, again, that relationship, that's been a big part of it. And I don't know, one byproduct, the tax benefits, by the way, of being a real estate professional in the eyes of the IRS is monumental. I mean, the money that saved me by investing in real estate is offset basically any income that I make from the brokerage side of things. And I have a team of people that works for me on the brokerage side. Like, I don't actually get in the car and show buyers around or list houses. The team does, but I get some of my income comes from that source.
Yeah. No, that makes perfect sense. The other thing too, to make note of for anybody listening, is that you found a 10 unit on the MLS, and I've purchased some commercial multifamily off the MLS as well. I bought a mixed use property off the MLS. So make sure you've got some sort of subscription to the MLS, or have a broker or real estate agent that's sending you these deals, because a lot of people, they don't know how to sell them. You know what I mean? You go to your local brother-in-law that's selling houses and, tell them to sell your 10 unit, and they don't know where to put it. So
that's right. That's
one exactly of those things. Right. MLS does have some treasures on there if you look in there, and no one else can deal with anything with it. You know what I mean? Especially once they get over like 5 units or 4 units and there's no more home financing allowed for it. And people are like, well, I don't know how to deal with this anymore. And that's where you can come in and kind of really level a playing field a little bit.
Yep. Amen. Well said. I agree.
So Ashley, as we're kind of wrapping up here, decades and decades of experience in multifamily investing, what would be some of the common mistakes you see real estate investors make?
Well, 2 are right at the top of my list. Number 1, thinking that you have that. So saying, I'm going to make this investment and I'm going to manage it myself. Now, I don't have a problem with you managing it yourself, but if you manage it yourself to quote unquote save the cost of the property management, in other words, you don't have that 10% line item in your spreadsheet and you think it's a good deal only because you've put a 0 where that 10% should be, that's a mistake. Because number 1, you don't value your own time. And so you're basically buying yourself a job, by doing that. But worse than that is that someday it's highly likely, if you own it long enough, that you're not going to want to manage it anymore yourself. Maybe you get sick and you can't do it. Or maybe you decide you want to move and live near your grandkids across the country, but you don't want to sell the asset. And so if you're forced into hiring a third-party manager and you don't have that number in your budget, well, guess what? You're now in financial trouble and it's not a good investment. So I think when you're doing your underwriting, you have to leave those things in the spreadsheet. You have to say, I'm going to leave in here 10% for property management. And if I manage it myself, then that's just gravy, but at least I know it's a good investment. That's a big mistake and that I see. And the other one is being undercapitalized. If you don't have enough cash to weather the storm, you say, well, we'll just turn units as they come available. And so I don't need a bunch of CapEx reserves. Well, then inevitably something happens, and, maybe we live in hurricane territory. So maybe a hurricane comes and you say, well, I'm going to get insurance. Well, that's fine, except that it takes 6 to 9 months to get paid out. And what are you going to do in the meantime when your tenants don't have a roof over their head? If you don't have the ability to get through stuff like that, or even on a smaller scale, just, weather a hard time or a bump in the road, and you can't pay your bank bill or your light bill, then things get kind of tough and it's not as fun. So I'd say make sure you have enough cash.
That's a lot of good information there. Having your reserve funds and making sure your property cash flows. And the other thing too, with your 10%, putting the property management, I think the other thing too is if you're forced to sell it and you're selling it to a sophisticated buyer or a more sophisticated than you buyer, they're going to pencil it in and there goes your value. You know what I mean? So
great point. Yeah.
Real estate, I mean, people always say it's a non-liquid, which it isn't. It's not liquid, but there's always ways of making it liquid. Obviously, you could sell it, but also you could refinance it, things like this. And this is what the bank, this is what all lenders, and when you're selling it and buyers are going to look into it and making sure those numbers are there. And when you're buying it from a mom and pop, you'll get a deal. And if they're self-managing it or they've got some weird setup where, they had someone living there and they're doing this, and you're going to have to clear that out and you have to put in that 10%. And know that this is what I'm going to be paying for it, not what they're paying for it in that situation. And I think that's something too. People are really relying on past numbers, and it's not really indicative of what's going to happen for you in the future.
Yeah, that's an awesome point. That's maybe even more important than what I said. But yeah, that's your future value. Same with vacancies, right? You have to have a vacancy number in there, even though, well, I'm sure this thing will rent like crazy. It'll never be vacant, but the bank's going to make you have 7% at least in there. And so if the spreadsheet doesn't work, you're not going to be able to borrow the money.
Yeah. I like how you said 7% because the overlying factor when you see a lot of these people put together pro formas, it's 5% vacancy and 3%, the straight line increase in rents, and none of that stuff ever happens. You know what I mean? I know someone just phoned it in. They're like, oh, this is just set in the spreadsheet, so we'll just use it. And you're like, especially on smaller properties, man, you're not having a 5% vacancy. And it's just one thing you're like, no, it's not a thing.
Yeah, and those rent growths, we've lived this for the last couple years because the rent growths haven't been there. I mean, we've been lucky enough we haven't had much of a decrease on most of our properties, but it's been a lot of pressure on rents. So if you have your spreadsheet that you have to bank on a 5% rent increase or even a 3% over the last few years, you're in trouble. Yeah, for sure.
Definitely. Ashley, thank you so much for coming on. How can our listeners learn more about you and your business, ABG?
Sure. So I think the easiest way is to go to our website, which is abgmultifamily.com. And from there, you can find all the different ways to connect us, and two of which are YouTube and LinkedIn. And we're pretty active on both of those outlets.
Okay. Well, thank you so much for coming on today. Looking forward to connecting with you here in the near future.
Yeah, thanks, Charles. I appreciate it.
Hi guys, it's Charles from the Global Investors Podcast. I hope you enjoyed the show. If you're interested in getting involved with real estate but you don't know where to begin, set up a free 30-minute strategy call with me at schedulecharles.com. That's schedulecharles.com. Thank you.